Welcome everybody to our quarterly economic update for the third quarter of 2020. We have got a fairly straightforward agenda today. We're first going to talk about the U.S. economy and how the effects of gasoline usage, TSA checkpoints, home sales, auto sales, etc. are affecting the forecasted GDP. Next, we'll touch on interest rates and unemployment, and we'll conclude our discussion with some Q&A. Basically questions that we've gotten a lot of, which include what is the disconnect between the economy and the stock market, and what is our investor outlook. So with that, we'll jump into the program, and I'll pass it over to Bob to talk about the economy.
Thanks, John. Wow, this is quite a task. Actually, we're truly in unique times. I guess I'll congratulate everybody for anybody that is watching this right now has just lived through the highest quarter of economic growth in history, although we won't find that number out until Thursday when GDP is released. GDP, of course, is just a measure of the broad market economy. We know that when we shut it down, GDP collapsed. What we weren't sure of is how quickly it would bounce back. At the beginning of this quarter, the estimate was for an 11% growth rate. By the end of the quarter, the estimate right now is for 34% growth rate. So there's been a lot of shifting underneath in the economy, but it appears that the economy is definitely bouncing back from the pandemic shutdown. Now, GDP, as we just mentioned, is sort of a slower moving variable. It takes quite a while to get the data in. We like to look at some of these quicker moving variables because they're immediately observable, things like gasoline. Gasoline has consistently been a great gauge of just where we are in our economy because every day we use gasoline and every day we know how much gasoline we use. It's interesting to see how much it dropped off in April, down to 5.3 million barrels at its low. It's bounced all the way back to 8.6 million barrels. So maybe this is the new normal since people aren't commuting, but it appears people are definitely active in the economy again and moving around. What's not really coming back right now is air travel. It's certainly bounced back from its pre-pandemic lows, but we were well over 2 million TSA checkpoints a day during the pre-pandemic. We dropped down 100,000 at its low, where we bounced back up to about 700,000 a day right now. If in an informal survey, it seems much more concerned or less about the concern of travelers getting coronavirus and much more between the restrictions on travel and any attractions you'd want to go see being shut down. There's just not a lot of incentive to travel right now. So what is sort of interesting is what's going on underneath at the economy. And we're just seeing home sales absolutely skyrocket. Just huge home sales numbers. People are moving out to the suburbs, people are moving out to resort areas or just more rural areas. People are craving space. Really since 2008, the trend has been urbanization. Empty nesters, millennials, everybody's been moving into the city. People love the idea of less being more. The attractions of the city, whether it's eating out or going to going to sporting events, has just been there, getting rid of your car, etc. Now we're seeing families that really need more space in their lives, whether it's home offices or schooling or whatever, and we're seeing this surge of people no longer renting and moving out and buying their own homes. And with that, as you move out to the suburbs, again, we talk about Uber and other rideshare apps, kind of really dampening auto sales for a long time. As people move out to the suburbs, people looking to buy cars again. This is kind of a interesting little wrinkle that's been going on in our economy right now, is that new and used car sales are through the roof. They've bounced tremendously as people have found the need to move around a more wide open landscape of the suburbs, and we're seeing inventory is very low, so prices are higher now, and it's been a big boost in the economy. And lastly, we can go up and down and say this sector's doing well and that sector's not, and there's a lot of truth to that. I mean, if you're in casino and gaming, you don't think the economy's bouncing back that well, but in other areas, it's absolutely going through the roof. And so if we aggregate, this is real consumer spending. This is just the aggregate level of real consumer spending, and it's really just simply astonishing. If we look at that blue line, what is going on there. It fell off a cliff as we hit the pandemic, and now we're back at all-time highs. So we're spending our money on different things. Reality is, though, that we are spending money. We're spending more money than we've ever spent as consumers. And we continue to go with the assumption that this is a temporary, not a permanent obstruction to the economy. There's not anything that was systemically broken, and that the economy should also be fine as the pandemic passes. And lastly, from a performance standpoint, it's almost humorous to look at the year-to-date numbers because it looks like a pretty boring year, and we all know it's been anything but a pretty boring year. But the lesson remains the same. Those that stayed have done just fine. We of course got the giant sell-off. We realized the world wasn't ending once again, and things have bounced back. And probably the biggest discrepancies are really in those underlying indices you see at the bottom, where you see things like small cap value, which tends to be more the service sector industries, really getting hammered, where people like large cap growth, which are the technology industries, which are doing things like watching this presentation and creating the server space for it, et cetera, they've absolutely boomed during this. But all in all, portfolios have performed just fine during this period. Going forward, we often see bounce backs after sell-offs, not always. It's important that we recognize that this is not an always thing. It really comes down to whether it is a temporary versus permanent, or maybe that's not the best word, but more of a systemic issue that's changed. So when we're in things like wartime or something like that, you don't see markets tend to bounce back, or when you're in even something like a Great Depression. But really, something like this, where we see the sell-off and nothing is systemically broken, markets tend to bounce back. We continue to expect markets to come back. We would argue that the S&P 500 has probably gotten a little bit ahead of itself right now. So we're expecting sort of a sideways consolidation, but we're getting tremendous earnings growth right now. We expect those earnings growth to eventually catch up, and for the S&P 500 to ultimately move higher over the next year, probably in the 5 to 8% range.
Thanks, Bob. So really, since the Great Recession in 2009, we've had one of the greatest economic growth periods in our history. We added about 20 million jobs since then and brought our unemployment rate all the way down to 3.5% in February of this year. And then the pandemic hit, and our unemployment skyrocketed up to 14% in April. And since then, it's been slowly coming down. And our most recent read in the last couple of weeks, we got a 7.9% unemployment read in October. And from here, we'll kind of see if that unemployment rate continues to come down, and it'll largely be dependent on how this virus goes. Interest rates, the Fed has come out and said that they are going to do it. Their plan is to keep interest rates near zero. They said that earlier this year, and they're likely to stay that way through 2023. And if we can remember, during the global financial crisis in 2008, the Fed did something very similar, and they kept rates near zero for 7 years during that time. We did a little look on the mortgage rates in our local area in Upper Michigan, and as of a week ago, we were seeing 30-year mortgage rates at incredibly low interest rates at 2.85% and 15 years at 2.5%. Lines of credit were even below prime at around 3%. So it is a great time to refinance your mortgage. We've been trying to contact many of you, and I think many of you have done that. If you haven't, you really should take a close look at that. Credit card debt interest, this hasn't come down as much because these rates are based off of prime, and a 1% drop in prime really isn't going to have a great impact on your credit card debt, but I'm assuming most of you don't have any credit card debt that you're paying interest on, at least we hope so. One of the downsides to interest rates is that our savings and checking accounts are yielding near zero, and it's probably going to continue that way for quite some time. So over the last few weeks, Bob and I have got many different questions from all of you, but for the most part, we've got 2 or 3 very common questions, and we're going to go through those right now. And I'm going to let Bob talk about this one first.
Yeah. So the disconnect between the economy and the stock market is that the stock market is forward looking. And they're not contemporaneous. So the stock market is looking at what the future holds right now, and it sees the economy doing well going forward. Obviously, when it sold off, it saw the economy doing very, very poorly, but we are seeing real strong earnings growth as earnings season starts here. It appears, again, where I'm not a virologist or an epidemiologist, but I think the consensus is that one way or the other, this pandemic will gradually disappear over the next, hopefully, 6 to 9 months, and the economy should recover. And as the economy does so, earnings recover, and we've already started to see that. So the stock market's a forward-looking instrument, and looking forward, it sees a very positive-looking economy.
So one of the most emotional questions we get these days is, what is the impact of the elections? And we have people on both sides that are very bullish with the election. More people are very pessimistic, want to be in cash. Bob and I have looked at many, many, many charts throughout history, and we can tell you that there is really no significant correlation between how government is situated between Democrat or Republican controlled on how the market behaves over the long term. Now, in the very short term, immediately after election, it's anybody's guess. But from a long-term standpoint, the election is not going to have a material impact on our investment plans.
So going forward, we see the market extremely volatile between now and year end. It's what we call consolidation. We think the market will ultimately not really move a whole lot higher or lower, but it's going to, on a short-term basis, move quite a bit higher and lower, and kind of get everybody's nerves going a little bit. What we're seeing right now is that markets really just got a little bit out in front of themselves. So valuations are a little bit stretched, the multiples on earnings. We are seeing earnings growth catch up pretty quickly here. So our expectation is that we're going to kind of do the sideways pattern through the year end and give earnings a chance to catch up once we get to year end and beyond. And hopefully as the pandemic starts to ease, we do expect the market to continue higher. We don't see anything systemically wrong in our economy right now. We're seeing growth, and there's no reason why growth shouldn't return. And really, I think it'll be interesting to see, just from a pent-up demand standpoint, what this economy holds. But I would not be surprised to see a pretty big upside surprise here.
On behalf of all of us at MMFS, we want to thank you all. Hope you're staying healthy, and we all very much look forward to seeing you all in person again very soon.